Welcome back, guys, to the Business Wealth Podcast. Trevor, we got a good episode today. Did a bunch of work for this one, so.
Yeah. It took a while for you to get prepared for this one. So What are we talking about today? And, how does this relate to our audience and Canadians in general?
Well, we can see people freaking out about housing prices. So, in some parts of the country, they're freaking out about it. In other parts of the country, things are still going well, and people need to take a step back because there's a bunch of people on X misleading you down the path, saying that it's all about housing prices are all about population growth or lack thereof, and the sky is falling. And we're going to break it down and bring receipts. So.
Well, put it into context. People who are in Vancouver, people who are in the GTA. Yeah, things are being affected there, but in the middle of Canada and on the outskirts, things are not the same as in those highly populated areas with inflated housing prices, right? True.
Even in Vancouver, if you're looking at the most desirable properties, nothing has moved. You know what I mean? Mm-hmm. It's still high. Yeah. You're looking in not the AAA grade locations. You're looking in the AA locations, because I'm always looking at stuff in Vancouver when I'm there. So let's jump into it and kind of give people the context of what people are seeing.
Sure.
Here is our real estate map that we post all the time here. And you can see BC down 4.1%. Northwest Territories down 4.4%. BC down 4.1%. Northwest Territories, I always take it with a bit of a grain of salt because they're small markets. So when you see large percentage change in small markets, it's it's not. It's more. It can be a statistical anomaly. So you really got to look at this over time, right? But in BC, 4.1%. That's a large market.
Mm-hmm,
okay?
Sure.
$960,000 people in Alberta. Saskatchewan, Manitoba, they're like, what the heck's going on? The real estate market is fantastic. What are these guys talking about, right? And then Ontario, they're down by 3.6%. Okay. And it's an oversimplification that people have. You can also see Newfoundland down by 8.5%, but, simultaneously, Quebec up by 8.4%, right? And so the tendency with housing prices, a lot of it comes from, realtors who want to sell you a house or something like that. They'll oversimplify it on that it's just population, that it's population and only population, okay? And probably what really got this discussion going with a lot of people is just the actual population. So you're looking at the Q2 population in Canada there. And essentially stuck at 41.5 million. I'm going to count the difference, is just, statistically insignificant here. 41.5 million. So zero population growth in the quarter, which is, looking back, it's that is, one of the lowest numbers ever.
Sure.
Ever recorded, 41.5 million. But simultaneously, it's coming off some of the highest increases in history here too. So you start looking at some of these increases. They're pretty significant. Kind of looking year over year. For example, if you're looking for Q4 2021 to Q4 2022, we're moving from 38.4 million to 39.2 million. Okay. And then from Q4 2022, from 39.2 to Q4 2023 to 40.5 million. Okay. And then 40.5 million to, basically 41.4 million, almost a full million people in one calendar year.
And,
right?
that's pretty significant. A million people per year for a few years straight. That's kind of a big deal.
Big deal. Yeah. But as I always tell people, when in doubt, zoom out. Zoom out. And that's what we're going to do. And we're going to show you, because you start to look at these aggregate prices here. And I've seen this chart shared around online, and you can see the housing index top in Q1 2022 in Canada and then sink dramatically. But of course, it's a much different it's a much different discussion depending on which region of the country that you're in. Okay. A much different, discussion depending on what region of the country that you're in. Okay. And so population growth is one variable and only one variable. And I would argue it's actually not the biggest variable. And the biggest variable almost nobody ever talks about. And I will tell you what the biggest variable is. Right. Okay. And so here's the data. This is the actual data. Okay. So we talk about population increases. Yes. Okay. Population increase. It matters. How many people are looking for houses? That matters. Okay. And, people will talk about supply. They will talk about the supply of houses. Okay. But the variable they never talk about is the dollars you're using to buy the houses. And that is the most significant variable in the entire equation. Okay. And the realtors don't talk about it. The mortgage brokers don't talk about it. The people who sell you investments at the bank don't talk about it. But the dollars that we're using to buy them, what is the value? What is the number of those dollars in circulation here? Okay. So I've assembled some data for you here. And this data is, we're looking at the M2 money supply, the broad money supply in trillions of dollars in Canada. Okay. Trillions of dollars. Comically enough, we, in 1971, and there's a reason why we start in 1971. We teach everyone at the bootcamp of what changed at that point. $40 billion in circulation. $40 billion.
Just $40 billion.
$40 billion. That's like, less than our annual deficit today.
Yeah.
that's less than the annual deficit in Canada today. And then we also look at the population increase. 1971, there was 22 million people in Canada.
So roughly half.
22 million people.
20 million less than what we have today. So.
That's right. Yep. And then the number of housing units. Now, we've gone through a couple different statistical changes since 1971 and how they're counting housing units, but different sources, but I've tried to smooth it out for people. But there were 6.4 million housing units, the actual stock of housing, right? Because people they keep talking about this. It's like, oh, we don't have enough units. But when was the last time you heard in parliamentary debate of how many units? How many do we have? How many population is too high? How many did we increase, right? How many housing units? It's kind of difficult to search through the data, so they don't want to actually prepare for it. So, and then we get the average price of a house. And you could have bought a house for $123,000 way back in 1971. Yeah. So. Wow. Not bad.
The average price. So imagine buying a house in, Toronto or the GTA for $123,000. That's incredible.
Yeah, just on average, you 5x your money. Not a bad deal, right?
Right.
That's the bag of potatoes, okay, that they talk about. Yeah. So, okay, and that's a housing unit. So that's an average between the small condos and the single family houses.
Yeah,
that's an average. Okay. Let's fast forward to today, and everyone is talking about that population increase. It's like that population increase, it's choppy, okay? But I would suggest, I don't really, I don't have the highest degree of faith in the government to get this exactly right every quarter. Like, I'm posting these numbers. We know that they amend these numbers all the time. So they amend them all the time. When we're posting the current month's numbers, they often amend the prior month's numbers or the prior quarter's numbers. So, I would suggest that, slow down, people. The population decrease in any quarter could be a statistical anomaly. Okay.
Yeah,
you need to zoom out. But even the population increase that led up to this, most people are going to be absolutely shocked when I show them. Is they would think, I'm sure if you ask the average person, that the population increase in the last 25 years has been absolutely dramatic. And
asking anybody today, that's what you're going to get. They're going to say, oh, the population has grown, astronomically in the last little bit. But you know what? Like we talked about just before the podcast, is like, okay, so we had very, very low, but then 1 million people per year, 3 years in a row. Yeah, that feels like
completely disorganized chaos.
Yeah, that feels like ridiculous.
Complete chaos. Yeah. But ultimately, these numbers start to even out, and in a way that should give you a predictable methodology to make financial decisions. That's the goal here, right? It's like not what should they do, it's what they're going to do and how you should play it to build wealth for you and your family. Okay. And so this will be the absolute most surprising part for most people is the compound annual growth rate for population in Canada in the last 54 years has been 1.2%. In the last 25 years, it has also been 1.2%. It's not as abrupt as everyone thinks it is. It was complete chaos.
Yeah, sure.
You could argue about the quality and the expertise of the people that came into the country, and going from 1 million people in a year to 0 people coming in 1 quarter, like completely unnecessary. Puts a lot of strain on the system and infrastructure. It's not organized at all. But when you're zooming out, when you're trying to make an investment decision, that's less important.
Right.
It's less important. Okay. And what actually is like we've been 1.2% for 54 years in Canada. That's been our population increase. And so I would suggest anybody betting on the population increase to stagnate is wrong. And anybody betting that it was going to go for, continue on at 3%, also likely wrong. Okay. Because these increases were wild, 2.3%, 3.1%, 2.5%. But you can see it follows 2020. That was one of the lowest population increases on history because nobody was traveling. Nobody was moving. Sure. It was hard to get, work permits, done. It's like people weren't getting, foreign student permits. Like no one was coming in. Okay. So it's one of the slowest population growth periods in history. And then, we look at 1 quarter here at 0%. When you start averaging this stuff out here, it's, you start averaging that out, it's, 1.6%. Higher, but not probably the range that people thought it was going to be.
Right.
Okay. Now, we talk a lot about housing units. Okay. Here's where you start to see housing units. Okay. How many housing units? We actually had, some pretty decent growth of housing units. We had 1.9%, 1.2%, and then 3%, 1.8% in 2024. And really the completion of housing units has also fallen off a cliff. Developers are very hesitant. They don't have a lot of money to spend. It's like it's 0%. But here's where you start to see a deviation where the population increase has been 1.2% pretty consistently for 54 years. Same in the 54-year compound annual growth rate as it has been in the 25-year compound annual growth rate. Our construction of housing units has not, though. It has not been the same. Okay, we have increased the number of housing units in Canada on a compound annual growth rate over 54 years, 1.9%. But when you look at the last 25 years, it's only 1.4%. Okay, it's only
that's not good. So you can chalk up a few different things to that, like the regulations, permitting. The municipalities really, charging a lot extra for development permits, time to get permitting and all that kind of stuff. That's kind of a big deal and probably relates somewhat to that growth. But what's the big deal? What's the biggest problem with getting things developed?
It's people. Like it's actually hard to build things. So it's financing. It's financing and people. That are really. It's not that people don't want to buy houses. Like the customer's part is pretty easy. People want to buy houses.
Sure.
Okay. But can you get the financing? If you're a developer, can you get the financing? A and B, if you can get the financing, if you can get that financing, do you have the people to build it? Do you actually have the expertise to build it? Okay. Yeah. Because we work with small developers all the time. It's like some of them, if they had more money, it took years to train the people that we have.
Yeah, for sure.
And, you get 1 million people entering the country, but they're all taking, some sort of, business admin degree at some university that no one's heard of before. Yeah. It's like, well, okay, well, who's putting in the ductwork on that house? You know what I mean? Who's installing the furnace there? Who's wiring that house? Not that guy, right?
Yeah, for sure.
That might be 10 years before that person with no skills is actually productive in this whole process. So that is the number, people. We've only increased the number of units by 1.4% on average. That's the compound annual growth rate in the last 25 years. And I would suggest the desirability for, it's not like people are living in the same house with the same size of family. The size of household per person is actually decreasing. So you actually need more units per person if, people aren't having 3, 4, 5, 6 kids.
Well, especially like, young people who are maybe just cohabitating together, not planning on having any children, 1 or 2, and then they just need a small apartment unit. So that counts as one of these units here. And, a lot of younger people, the outlook doesn't look great for them, and they don't feel hopeful for the future that they're ever going to be able to afford a home. Now, again, going back to, where you live matters. So if you go into a smaller center, someplace, in rural Saskatchewan or a smaller town in Saskatchewan, Manitoba, Alberta even, you can get an affordable place to live. You just have to, set your expectations of a different lifestyle, right? Yeah. But if everybody wants to congregate into the city, you got to be prepared to, save up for that down payment and then have all the criteria ready so that you can actually borrow the funds to get that unit.
That's right. Yeah. And so here's where you start to see what happened in the change in prices here is, housing prices on a 54-year basis, 3.2%. But in the last 25 years, 5.3%. So the compound annual, despite the depressed market today, which really affects the calculation, because if you're running this calculation a year ago, you're getting a number north of 6%.
Right.
Okay, so despite the market today being in a trough, it's still a 5.3% compound annual growth rate in the last 25 years. Okay, now the discerning person should ask that question: is if our population is increasing by 1%, and the number of housing units appears to somewhat keeping up, we just have to understand it's not quite keeping up because fewer people are occupying a housing unit because the size of families are shrinking. Where does the extra growth come from? You know what I mean? Like, well, why is it 3.2%? Why is it 5.3%? Right? They told us the inflation was 2%. Right. Where does this 3.2%, where does 5.3% come from? Okay, that's the compound annual growth rate. It's because of the single most important factor in every financial decision, which is the money supply. It is in the long term, it's the money supply. Okay, and we've grown the money supply on a 54-year basis at 8.2%. Okay, you really have to understand how the first kind of 10 to 15 years off the gold standard affected this whole thing. It's like, people are usually bamboozled on why inflation was so high in the 80s, and they have all sorts of misunderstandings about oil prices and things like that. It's like, no, because they jacked the money supply to rates that we had never seen before ever. That's why the inflation rate went so high. Increases in the money supply by 25%, 20%, 16%, 14%, 12%. It's like that. That's what happened. That's what led to the massive inflation in the late 70s and the early 80s. It was the money supply. Okay. And I'll give you a more recent example is how this affects everything. It's okay. Housing prices topped in 2021. The average price of a house in Canada topped in 2021 at $777,000. But remember, the same people are telling you today that it was all because of population growth.
Right.
Population growth. But what was the population growth leading up to that? The population growth in 2020 was one of the smallest population growths we had ever seen at 0.5%. And even in 2021, it was still less than the average at 1.1, with the average being 1.2. But that still meant houses grew from 543,000 to 613 to 777. What changed? Not the population. We had the largest increase in the money supply that we'd had in 40 years.
Yeah, so everybody remember that stimulus that they put out? Everybody got a bunch of free money to stay home. That's kind of what fueled this. That's part of what fueled the increase in the money supply, and then the boom in the house prices.
That's right. That's right. And so when you're making a housing decision, okay, the population increase is one variable, okay? But don't just look at the migratory patterns in and out of a neighborhood. You also have to look at the change in supply, okay? And this is where you can get really regional in this part of the calculation, because the migratory patterns are different, right? And you can start to see that play out. It's like, I think we got a population count here too. We could look at, our home province of Alberta at 4.3 million here, and now we're at 4,980,000. So, we had 20,000 new people on 4.9 million, okay? Whereas the entire country combined only had a population increase of 20,000, okay? Mm-hmm. So you start to look at how that works in terms of, we still had, there's no problem in Alberta, okay? But then you start to look at some of the other provinces that are struggling, okay? And you start to see migratory patterns that relate to this. And this data can be available at more regional levels too, okay?
Mm-hmm. Yeah.
Even sub-regional levels.
Right,
okay?
yeah, we're just taking a zoomed out picture, the whole country as a whole in its entirety, not taking into account the disparity between the regions and so forth. It's just an aggregate amount across it so that people can get a better picture.
That's right. But the part that is going to blow people's minds is, let's say you had no net new people. You have no net new people coming in, and you have no net new housing units being created. So basically, for every housing unit you create,
mm-hmm.
You demolish one because it ended its useful economic life. Okay, but if you jack the money supply, the housing prices still go up dramatically. They still go up dramatically. Okay, so if you tethered immigration significantly, and you're still meddling along in the number of units, this is still going to be the hammer. It's there comes a point in time that it doesn't actually matter if this is so significant. There's no reasonable expected change in population growth or housing units being built or demolishes. That if the change in the money supply was so dramatic, that's what causes it, right? That's what causes it. And a lot of people go back to why the housing prices were such a struggle in the 90s. It's like, in the 90s, you had some of the slowest M2 money growth ever. And so keep in mind, 8.2% is the average over 54 years, and 7% is the average over the last 25 years. But how tight things were in the 90s, it's like, we're looking at after 1990, then you get 5.4%, 2.6%. I mean, you have a long way before you actually get a year that's back to the average. A long way. Like there's 15 years almost there before you get a number that's 7 or more, and including 2 consecutive years with zero growth in the money supply whatsoever.
Yeah, and looking at your chart there, it looks like the housing prices basically remained kind of flat. And even decreased. Like you look at, goes from 215 to 191, 180, 70s, all into the 80s. And then they didn't come back up until the 2000s.
Exactly. Yeah. So what was this? This was not a factor of immigration. The population was still increasing at a slower rate, but not at a snail's pace. It's still 1% there. Okay. And the housing units being increased are still fairly decent. This was money supply. This was money supply. Just like, so when people say it, like, when people compare it to the 90s, you have to ask yourself, do you expect the increase in the money supply to be 0% for 2 consecutive years with the WEF banker Mark Carney at the helm. Like, no chance.
way.
There's no chance that that's going to happen. There's zero chance that we're going to have 2 consecutive years of M2 money growth, being 0% increase. Like, that is just not going to happen. We're tight right now. We're on 5.7%. I think he's kind of smart and attuned to this, that he actually knows, that, I guguess the pundits out there are telling me, though, the Bank of Canada is completely independent from the Prime Minister. It's like, sure it is. Yeah. And yeah. So, but do I think he's going to increase? Of course. Of course we're going to increase the money. But they're very attuned to the fact that Jerome Powell is being very hawkish. And I keep thinking, the U.S., why is Jerome Powell being very hawkish? Because Jerome Powell's looking out for Jerome Powell. Mm-hmm. He's the guy who created inflation in the first place. And the last thing he wants to do is reduce too quickly, because he doesn't care what happens after May. Once he's done his tenure as the head of the Federal Reserve, people are just going to remember the last year or two when he brought inflation down. They'll forget the fact that he actually, was at the helm when it went crazy to begin with, right? Yeah. So he has no personal motivation. When you're really wondering what people are going to do, it's like, well, what's best for them? What's in their best self-interest? Yeah. Like, usually you should start there if you're trying to predict what someone's going to do, right?
And he's setting himself up for what happens after the Fed. Like, what's he going to do after the Fed, right? Maybe he'll go and be in charge of another big bank or some other cushy position where he gets paid all kinds of money. Yeah. So let's talk about the money supply then, okay? Mm-hmm. So what are the factors that change the actual amount of money available or increases the money supply?
So the money supply, there's essentially like 2 large factors that really increase the money supply.
Sure.
They're somewhat interrelated. It's credit restrictions. So restrictions around getting credit, okay? So when you look, back in the 70s, people weren't putting 5% down over 30 years on a mortgage.
Right.
That wasn't the norm, okay? So people go from putting 30% down to 20% down to 10% down to 5% down. Those amortization periods go from 15 years to 25 years to 30 years, and they get stretched out. So it's the availability of credit. It's like, just look at an auto loan. Like, 20 years ago, who financed an auto loan over 84 months?
Right.
It was unheard of. Mm-hmm. It was unheard of. That, the restrictions around the lending practices around credit, obtaining credit, is one of the biggest ones. Like, where is most of the money produced? Most of the money produced is at the commercial bank level. Like, that's where the money is produced. Okay. When you put your money in there, they lend it out 10 times. Okay. And then it's at the central bank level. And people have to understand that the relationship between the government spending and the central bank. If the government spends a deficit, but private investors buy the bonds and fund that deficit, it actually soaks up liquidity, because that money moves from cash that's in bank accounts that's liquid into long-term Canada savings bonds, okay? But when the government runs a deficit and there's no buyers and the central bank buys it, that's an increase in the money supply. So the government goes out and spends that in goods and services, and like, now we're increasing the money supply, okay? So it's deficit spending, but specifically deficit spending that's then in turn monetized by the central bank. And then the hammer is when the central bank just goes out and start buying stuff. So which they did in 2007, 2008, 2009, quantitative easing, and what they did again during COVID, when they start going out and buying primarily mortgage-backed securities. And so the banks, once they're made whole on those obligations, they can just go out and lend the money all over again. Okay. And so quantitative easing, so it's basically the restrictions and rules around credit, easing the rules around credit, not just rates, it's the restrictions, because rates could be low, but if the qualification threshold is high, it doesn't actually increase the number of loans being given. So there's a relationship there, but it's not absolute.
Okay.
The interest rate itself is just one variable. If you got to qualify for a mortgage on 39% of your income, that's one thing. But if you have to qualify on 25% of your income, that's another thing. Okay. And so it's the availability of the credit and quantitative easing. And so, again, we talked about Jerome Powell in the U.S. that he's going to act in his own self-interest. It's like, what's Mark Carney likely to do? Well, what's in Brookfield's best interest?
Right.
Maybe someone should ask, what's in Brookfield's best interest? Does Brookfield buy houses? Yeah. So would Brookfield like to see a temporary pullback in housing before they increase the money supply? I mean, if you want to know what people are going to do, just ask yourself, what's in their best interest, right? Do they want it to go steadily up? Do the big players want assets that go steadily up and to the right, or do they like to have predictable pullbacks before wild expansionary periods?
Huge. I mean, just look at what's happening in the markets right now. Like, there's almost on a daily basis, there's some kind of new news cycle that's happening, and what does it do? It causes a little bit of fluctuation and volatility in the market, so that people are buying and selling, and they're waiting for things to go on sale so they can buy them up and then catch the bump on the way up. I don't see it being really any different with Brookfield and Carney. I mean, he still has vested interest in that company, even though he says,
his blind trust.
His blind trust.
He really thinks he put it in there and they rebalance the whole thing.
Like, it's a blind trust, but he still has access to it when he's done his tenure as prime minister. Like, how dumb do you have to be to believe that he's not benefiting from it? Anyway.
And so this is the point. Like, what do you do? What does the average Canadian do? How do you beat the odds at business and wealth? And this is more of a wealth decision here, is you have to change that calculation in your head from it's not just a population versus housing price. There's three big variables in that. It's what's the population increase, and that can differ in different regional areas. What's the supply in housing in that regional area? But then the big hammer, the big 800-pound gorilla, is what's the likely increase in the money supply? Do we think that Mark Carney is going to go Jean Chrétien and actually balance a budget? It's like, no chance that guy's balanced. Like, there's no chance. We're not even talking about balancing a budget. We're not even saying, we're going to have a balanced budget in 5 or 10 years. No one's even saying it. Not even the conservatives aren't saying it. No one's saying it, right?
For sure.
And so
one thing I wanted to point out was, if you've watched this channel for a while, how we had discussions even with the mayor of Vancouver, how inflation, the price of gold, has kind of gone up and stayed on par with the most desirable real estate. So in Toronto, in Vancouver, and gold, like, they're staying kind of at the same pace, moving up and down.
Yeah.
And as the money supply changes, of course, you look at how much it is for an ounce of gold today, right? Same kind of thing was happening with this desirable real estate. So maybe talk a little bit about that.
Yeah, very few places, we see the average compound annual growth rate of 3.2% in 54 years. And then we see the compound annual growth rate in the last 25 years of 5.3%. But that's a dramatic underperformance of gold. That's about 10%. The compound annual growth rate of, one of these ounces of gold is 10%. And so once you understand that, it's like, well, it kind of makes sense, because house really should be a depreciating asset. It's a collection of sticks that'll eventually fall down. Sometimes it's a piece of land, sometimes it's a very small square of land if you're building upwards. But ultimately, it's a collection of sticks. It goes up in value because of the increase in the money supply.
Right.
It's meant to be a depreciating asset, right? And we're supposed to get more technologically advanced. It's like, have you ever seen some of those like old drywall videos where they have like the little square of drywall? It's not like a big sheet. It's like a little tiny square and the guy is tacking it in. It's like, how long is that going to take that guy to drywall a house? Like, oh my goodness, right? Like, we're wildly more efficient at building houses today. But they cost more because of the inflation of the money supply, right? And so it comes back to the money supply. So when you're making these decisions, like, you have to consider what's the likely purpose of that money, like what's the likely outcome of that money supply. And when you buy houses, like when you buy any investment, the way you make good investment decisions is like, is this an asset that I want to hold for 100 years? None of us actually expect to live 100 years, but then you start making really good decisions.
Right.
Okay. And so, looking out, do I think they'll build more dog crate condos? I really think they will, right? I really think, there's a realistic expectation that dog crate condos go back to kind of the 3.2% increases while ounces of gold continue to wildly outperform it. So they're going to underperform real rates of inflation. 5.2 being the average, and it would be like, where's most of the appreciation? It's in highly desirable neighborhoods. So it's single family houses, nice single family houses, or more luxurious condos with views and excellent layouts, and in really, really desirable neighborhoods, right? And so those will continue to have good appreciation. But housing in general, when you really look at it, in order to maximize the performance, it's like you need to use some debt on it.
Right.
You need to learn how we can borrow money at 4%, okay, to acquire an asset that's at 5%, but then, we can borrow it and invest it at 10, okay? Right. And that's what we teach people at the bootcamp, because when you just look at housing in general, it's generally, for most people, they don't all live in, they don't all live in North Vancouver looking at the cliff and looking at the harbor. Like, they're very likely that their piece of property is going to underperform a pristine asset like gold, okay?
Right.
And so once you take the leverage out of the equation, it's like your actual real rate of return goes down, okay? And so knowing, like, you got to pick the right asset, right? And I would say you pick the right asset. Is this an asset I want to own for 100 years? So is this something that either I want to live in forever, or B, I think will generate me a decent rental rate of return?
Right.
Okay? Because you can make some real big mistakes on high-end real estate if your goal is to sell it in 3, 4, 5 years. Like, it's far less liquid, right? And I would say the government kind of sets the rules on that, where, they put that $1.5 million arbitrary number in there for high leverage mortgages, right? And they probably won't look at that for another 10 years like they did the last time, which is comical in itself. I hate when they put these arbitrary numbers in with no index.
Yeah. What was that based on?
No mechanism to index it to anything, because that means if it was right that year, it's automatically wrong the next year because inflation happened. So, I mean, there's probably, single family houses in good neighborhoods, less than 1.5 million, has some room to move upwards. But, buying a $2 million house and hoping that it goes to 3 million, it's tougher. It's tougher, right?
So it's probably more likely that's going to go down.
Yeah.
Depending on where it is, right?
I mean, you have to understand that's a less liquid asset. The buyer pool is so much smaller. Once you get over that high leverage limit, the buyer pool shrinks dramatically.
Yeah.
Okay. And even if you are going to sell, it's going to take way longer to sell it.
Yeah. Well, case in point, we had that exact scenario kind of happen with, we were selling a couple of properties in BC, priced it at $1 million or 1.1, buyer pool, not very much. Soon as we brought it down below that $1 million mark, buyers started opening up because of those arbitrary limitations.
That was prior to the change. So
prior to the change.
Yeah, exactly. Yeah. It bumps up to there. You can see, if you just look at, go on to realtor.ca and start looking at it, you'll see a lot of the real estate start to coagulate around that limit that's imposed by the government. It takes a while for it to bounce out of there because the buyer pool shrinks.
And it goes back to how easy is it to get the financing.
Yes.
And if they have that arbitrary limit, that number in place, it's much more difficult to qualify because you need a larger down payment. And the criteria for borrowing is much more stringent after that $1.5 million mark now.
Yeah. So, I mean, this is the point for someone. So, like, do not let a realtor, or someone else talk you in or out of buying a house simply based on population growth. Because, like, our population growth has actually been relatively stagnant. Disorganized, completely disorganized, but relatively, it's been 1.2% for 54 years. That's been the number. Likely to continue, okay? At least that or greater, okay? And so does 1/4 of 0% mean anything? Not at all. Doesn't mean anything. The supply of units, that means something, okay? The migration patterns of the place that you're actually buying, is the population increasing or decreasing in that specific area? But do not make any financial decision, any large financial decision, based on advice of people who don't understand the money supply, because ultimately, that is the 800-pound gorilla, right? I mean, you could have no new people moving in and no net new units, and if the M2 money supply goes crazy and you're a renter, you're screwed.
Yeah, that's
screwed.
Right. And remember, okay, so number one, these people are grifters, and they're trying to sell a house to someone or get them to invest in a property of some sort.
Yeah.
And then inflation. So increasing the money supply is a tax on people. So it changes the price of your home. Doesn't necessarily change the value of the home, but it changes the price of the home and goods that you buy.
It moves the money from all the people who do the work to it's going to devalue your wages, devalue the cash, and move it to the asset holders. And real estate is one of those assets, right? It's not the pristine asset. It's not gold. It's not high quality dividend paying stocks. It's not Bitcoin, but it will move it to real estate. And if leveraged the right way and utilized the right way, real estate holders benefit too. Okay. So that's what we have here today. Hopefully, people can start looking at their real estate decisions using those three variables, which is population increase, the number of units available, and the big one, the money supply. Okay. Hopefully that's helpful for someone out there. We really, if you want to learn more about how to actually leverage real estate and how to, increase your net worth, we'd love to see you at the boot camp. If not, you hit the like and subscribe, and we'll see you back here next week.
All right. Thanks, Josh.